We go. I think we're live. Welcome back again to another video created by moi. This video I'm titling, What are KPIs? KPIs. Have you ever heard that term? What is a KPI? Not just in the stock market venue or arena, but also in the uh, business or entrepreneurial world. KPIs are key performance indicators. And my name is Larry James. I own a company called Speakwithlarry, no spaces. And what I'm going to be talking about today are a variety of topics in line with the stock market. Now, if you've been following this series or whether you have purchased a course and you're watching this video as one of the courses, welcome. And I appreciate you investing into who you are and who you want to become. Because a lot of times we want something, we want to become someone, but we don't want to invest financially in our own growth. Now that's kind of contradictory to me, because who's supposed to do that for you? If you don't take the time out or set a budget or a system up in place for you to be able to purchase courses or read books, which you have to buy books as well, or become a member of audio podcasts or something, or video podcasts, where you can just kind of gain perspective from a different view from people who are actually doing what it is that you want to do. And it's not that difficult. Actually, it's a lot of fun too, especially if it's in line with what you enjoy, because it's based on what you enjoy. The way my company teaches you how to set up your own online business is for you to identify what you have a passion for, or what you enjoy doing, or what you would like to learn. Either of those is an option for you. If you already know what your passion is, all you have to do is be able to put that passion in a package and market it to an audience that you create. Now, how do you create an audience? Just like I'm doing right here. You create videos and you share information about that specific topic. And as you're doing that, people start to get to know, like, and trust who you are. And they also begin to buy in what you have available, what you have to offer. But that's a little bit farther down the road. I want you to focus on right now the stock market, because that's what I have an interest in. And that's why I'm creating these videos, so that you can learn more about the stock market, so that when you're preparing yourself to invest in the stock market, you have an understanding, or a better understanding, about how things actually work in that particular arena. And it's very interesting, because a lot of things you already know, but a lot of things you have no clue about, I'm sure. And that's okay, because that's how we learn. Okay, so I'm going to begin again with the topic is, what are key performance indicators, or KPIs? Key performance indicators refer to a set of quantifiable measurements used to gauge a company's overall long-term performance. And KPIs specifically help determine a company's strategic, financial, and operational achievements, especially compared to those of other businesses within the same sector. Okay? Now, when we talk about the definition of KPIs, that was it. But when we're talking about understanding KPIs, then we go into another realm. And that's what I'm going to share with you right now. Okay, excuse me. So also referred to as key success indicators, or KSIs. KPIs vary between companies and between industries, depending on performance criteria. For example, a software company striving to attain the fastest growth in its industry may consider year-over-year revenue growth as its chief performance indicator. Whereas contrarily, a retail chain might place more value on same store sales as the best KPI metric in which to gauge its growth. Now, a tip about key performance indicators is, you want to gauge a company's output against a set of targets objectives, or industry peers. And there are also different types of KPIs, or key performance indicators. Uh, Key performance indicators tied to the financials typically focus on revenue and profit margins. Net profit, the most tried and true of profit-based measurements, represent the amount of revenue that remains as profit for a given period. Now, after accounting for all the company's expenses, taxes, and interest payments for that same period, that's the net profit. Now, calculated as a dollar amount, net profit must be converted into a percentage of revenue known as net profit margin to be used in comparative analysis. For example, if the standard net profit margin for a given industry is 50%, a new business in that space knows it must work toward meeting or beating that figure if it wishes to remain competitively viable. And that makes sense, right? Now the gross profit margin, which measures revenues after accounting for expenses directly associated with the production of goods for sale, is another common profit-based KPI. A financial KPI is known as the current ratio. It focuses largely on liquidity and can be calculated by dividing a company's current assets by its current debts. A financially healthy company typically has sufficient cash on hand to meet its financial obligations for the current 12-month period. However, different industries rely on different amounts of debt financing. Therefore, a company ought to only compare its comparative ratio to those of other businesses within that same industry to ascertain how its cash flow stacks up among its peers. Not too difficult, right? Some of this is going to be more complex than you're familiar with, but that's okay. It's all learnable. You can digest it in time, especially once you've heard what things are. Now, some special considerations for KPIs. One of those is do not necessarily have to be solely tied to financial data. While profits and debt levels are indeed important, key financial indicators, a company's relationships with both its customers and its employees, are no less important to establish its general health. Common non-financial KPIs include measures of foot traffic, employee turnover rates, the number of repeat customers versus new customers, and various quality metrics. Got it? See, that wasn't too difficult, right? This is exactly what you're going to do when you're creating your online business, according to my company, Speak with Larry. You're going to come up with your topic. You're going to specifically set 3-month period that you're going to share information 2 days a week, and you're going to create content via Zoom interviews or Zoom platform, which is free for you to use, right? They have everything. Once you do that, then you'll upload it to your YouTube channel, and then you're ready to go, right? And I'll get more into that later after I finish with a few more of these definitions. Now, what is net profit margin? The net profit margin, or simply net margin, measures how much net income or profit is generated as a percentage of revenue. It is a ratio of net profits to revenues for a company or business segment. And net profit margin is typically expressed as the percentage, but it can also be represented as a decimal form. The net profit margin illustrates how much of each dollar in revenue collected by a company translates into profit. And the formula and calculation for net profit margin is revenue minus cost of goods sold minus operating and other expenses minus interest minus taxes. That's the calculation for the net profit margin. Next term I want you to understand is leverage. What is leverage? Leverage results from using borrowed capital as a funding source when investing to expand the firm's asset base and generate returns on risk capital. Leverage is an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital to increase the potential return of an investment. And leverage can also refer to the amount of debt a firm uses to finance assets. Now, if you want to understand leverage, leverage is the use of debt, which is borrowed capital, in order to undertake an investment or project. The result is to multiply the potential returns from said project. At the same time, leverage will also multiply the potential downside risk in case the investment does not pan out. When one refers to a company, a property, or investment as highly leveraged, it means that item has more debt than equity. And the concept of leverage is used by both investors and companies. Investors use leverage to significantly increase the returns that can be provided on an investment. And they leverage their investments by using various instruments, including options, futures, and margin accounts. Companies can use leverage to finance their assets. In other words, instead of issuing stock to raise capital, companies can use debt financing to invest in business operations in an attempt to increase shareholder value. Investors who are not comfortable using leverage directly have a variety of ways to access leverage indirectly. And they can invest in companies that use leverage in the normal course of their business to finance or expand operations without increasing their outlay. Now, more special considerations in that arena would be through balance sheets analysis, investors can study the debt and equity on the books of various firms and can invest in companies that put leverage to work on behalf of their businesses. Statistics such as return on equity, debt to equity, and return on capital employed help investors determine how companies deploy capital and how much of that capital companies have borrowed. To properly evaluate these statistics, it's important to keep in mind that leverage comes in several varieties, including operating, financial, and combined leverage. Got that? Right. We're right on track then. See, that's what I want you to do. I want you to just follow along. And at any point you're not really clear on what I just read, just play it back. That's one of the beauties of this process is that as you share information, when someone doesn't get what you're saying, then they can go back and listen to it again. Or in my online courses, I include the actual text as well. So you have a couple of ways of gaining that information. Now the next one is, what is a leverage ratio? A leverage ratio is any one of several financial measurements that look at how much capital comes in the form of debt, which are loans or assets, the ability or assesses the ability of a company to meet its financial obligation. The leverage ratio category is important because companies rely on a mixture of equity and debt to finance their operations, and knowing the amount of debt held by a company is useful in evaluating whether it can pay off its debts as they come due. Got it? I love it. Next, what does leverage ratio tell you? Too much debt can be dangerous for a company and its investors. However, if a company's operation can generate a higher rate of return than the interest rate on its loans, then the debt may help to fuel growth. Uncontrollable debt levels can lead to credit downgrades or worse. On the other hand, too few debts can also raise questions. A reluctance or inability to borrow may be a sign that operating margins are too tight. And there are several different ratios that may be categorized as a leverage ratio, but the main factors considered are debt, equity, assets, and interest expenses. A leverage ratio may also be used to measure a company's mix of operating expenses to get an idea of how changes in output will affect operating income. And fixed and variable costs, there are two types of operating costs. Depending on the company and the industry, the mix will differ. And finally, the consumer leverage ratio refers to the level of consumer debt compared to disposable income and is used in economic analysis by its policy makers. Interesting stuff, right? Good. I like that. And see, this is one of the beauties of being able to create all this content is you can do it at home at your own pace, and then you package it, and then you put a price point on it, then you sell it. You market it to the audience that you've created, or just you market it to the marketplace, which is the world, right? Which is a beautiful thing. I love being able to do that. But if you're interested in, learning more about that, just reach out to me at speakwithlarry.blog and put in your name and email address, and I'll get back with you. And I also have a book available that I've written called You the Most Valuable Piece to Your Success. By you putting your name and email address in there, you'll get a free e-copy of that. So don't hold back on that. And with that, I'm going to close this segment because remember, I'm putting these in a course. So I don't want these to be too long. I want to try to keep them below 20 minutes if I can. But I get to talk and I get to enjoy what I'm doing. And before I know it, I've gone too far. So with that, again, I appreciate you investing in who you are and who you want to become. And my name is Larry James. My company is Speak with Larry. And as always, share with someone else what I've shared with you.